In the vast world of stocks, certain things can be quite confusing. Although, within this video, we're going to make it easy and I'm going to break down to you what a stock option is. We're going to be going through the differences between a call and put option, as well as give you a full explanation of what a strike price is and how you can effectively use options in order to make money and be profitable. Let's go. Yo guys, Rethink Solutions here, and in today's video, we're going to be explaining the wonderful world of stock options. Let's go ahead and jump into it. So what exactly is a stock option? Stock options are financial derivatives that give an individual the right but not the obligation to buy or sell a specific number of shares of a company's stock at a predetermined price, known as the strike price, within a specific period of time depending on the contract expiration date. Stock options are often used as a form of compensation for employees, as well as for speculative and investment purposes by traders and investors. One option is called a contract, and each contract equals to 100 stock shares of the selected stock. Within the options world, there are two different contracts in which you can purchase. You can purchase two different types of stock options called the call options, or you can purchase put options. The call options give the holder the right to buy a specific number of shares at the strike price before a specific expiration date, and this usually applies if you know the stock is going to go up and that's your prediction. Vice versa for the puts, if you think the stock is going to go down, then in this instance you would play a put option at the strike price. What exactly is a call option? A call option is a financial contract that gives the holder the right but not the obligation to buy a specific quantity of a particular underlying asset, such as a stock, at a predetermined price within a specific period of time, such as the expiration date. Now, how do you acquire one? To acquire a call option, the option buyer must pay a premium to the option seller. This premium is essentially the cost of obtaining the right to buy the underlying stock at the strike price. The premium is determined by various factors, including the stock's current price, the strike price, the time until expiration, and market volatility. Now, there are different types of call options and strategies. Call options are often used by investors and traders for various purposes, including speculation trading, where traders can buy call options with the hope that the underlying stock's price will rise significantly, allowing them to profit by exercising the option or selling it at a higher premium. When hedging, investors can use call options to protect their stock holdings from potential price declines by buying call options. They can offset potential losses in their stock positions. Income generation. Some investors sell or write call options against stocks that they already own to generate additional income. This is known as covered call writing. So guys, for example of a call option, right now I currently do have the Amazon stock pulled up. So right now Amazon cost about $137.75 per share. So for a call option example, if I think the stock is going to go up to 140 per se, then in this instance I would be playing a call option due to the fact that I think that the stock is going to go up. Now, any number above 137.75 that I think that the stock would reach, in this instance, then you would play a call option. So a call option is when you think the stock is going to go up and you play your number prediction. So guys, right now I have the Amazon stock pulled up on Robinhood, which is a broker in which you can trade options on. There are plenty of those. Although, as you can see, it does have the Amazon price here at 137s. So anything higher than that, we would place a call option, which you would select right here. So, as you guys can see, the closer you are to the number, the more expensive that the strike price contract actually is going to be. Although, the further out the number, the cheaper it gets. So, a really good strategy that people like to do, that say right now the Amazon price is at 137.75, if you think it's going to go to 140 based off of your chart knowledge, then you can actually buy a 140 contract instead of a 138 contract for cheaper, and actually potentially end up making a lot of money for less risk due to the fact that you played a further out number. So the further out you guys go, as you guys can see, the cheaper the contract gets because the contract is not in the money yet. What exactly is a put option? A put option is a financial contract that gives the buyer the right but not the obligation to buy a specific quantity of a particular underlying asset, such as stock, at a predetermined price, within a specific period of time, which is known as the expiration date, which will be covered later in the video. How do you acquire a put option? To acquire a put option, the option buyer must pay a premium to the option seller. This premium is essentially the cost of obtaining the right to buy the underlying stock at the strike price. The premium is determined by various factors, including the stock's current price, the strike price, the time until expiration, and market volatility. Now, there's different types of put options. Speculation trading, which is most commonly used, where traders can buy put options with the hope that the underlying stock's price will lower significantly, allowing them to profit by exercising the option or selling it at a higher premium. The cash secured put involves writing a put option and simultaneously setting aside the cash to buy the stock if assigned. If things go as hoped, it allows an investor to buy the stock at a price below its current market value. So guys, for example of a put option, so as you guys can still see, we have the Amazon price at 137.75 a share. So anything lower than this, guys, anything lower than that number, the prediction we're going to be making, we'd be playing a put option, due to the fact that a put option is the prediction that the stock is going to be going lower. So if the stock is at 137.75 and I think it's going to go to 135, then we would play a put option in this scenario. So I'm going to go ahead and show you guys a couple examples on Robinhood now. So guys, for example here, we have the Amazon share price at 137.82. So anything lower than this, guys, we would be playing a put prediction. And just like the previous example, the closer you are to the number, the more expensive that the contract is going to be. This is due to the fact that the contract has a higher possibility of reaching the closest number within its range faster. Although, the strategy that a lot of people do is you actually play a number further down out of the money, in which you can profit by risking less with a potential to make a lot. So, as you guys can see, if you think that the share price is going to go down, then you guys would play a put option for your contracts. What is a strike price? The strike price, also known as the exercise price, is a crucial component of options contracts, including both call and put options. It represents the predetermined price at which the buyer of the option has the right to buy or sell the underlying asset. The strike price is specified in the options contract when it is created and remains fixed throughout the life of the contract until it either expires or the buyer has exercised the option. So guys, for example of the strike price here, as you can see, I have my Robinhood options chart pulled up once again. So the Amazon share price is currently 137.82. So for a call scenario, anything above 137.82 is going to be a call. So guys, if I think the stock is going to move upwards, I would play a strike price above the share price. So anything above 137.82, such as 139 for example, if I think this stock is going to go to 139 from 137.82, then I would play a call strike price of 139 due to the fact that that's where I think that the stock is going to go to. Now, for a put example, if the share price is 137.82 still, and I think the stock is going to drop down to 135 per example, I would play a strike price below the share price. So anything below 137.82, you would play a put. Now remember guys, the strike price, all it is the prediction in which you think the direction is going to move. For calls, if you think the stock is going to move upward, then you would play a call strike price above the share price. If you think that the stock is going to move downward, you would play a strike price below the current share price. What are Greeks? Stock option Greeks are a set of mathematical metrics used by options traders and investors to assess and manage the risk and potential returns associated with trading options. These metrics help traders understand how changes in various factors such as the underlying stock's price, volatility, time to expiration, and interest rates will impact the value of their options positions. There are 5 main Greek letters used to represent these factors: delta, gamma, theta, vega, and rho. Let's go ahead and jump into what these are. So let's go ahead and explain all the Greeks and what they exactly do. Let's start with delta. The delta measures the sensitivity of an option's price to changes in the price of the underlying stock. It is expressed as a value between 0 and 1 for call options and -1 to 0 for put options. A call option with a delta of 0.50 means that for every $1 increase in the stock's price, the option's price will increase by 0.50. A put option with a delta of -0.50 means that for every $1 decrease in the stock's price, the option's price will increase by 0.50. Let's jump into the theta. Theta measures the rate at which the option's value erodes with the passage of time. It reflects the time decay of an option's premium. As time passes, options tend to lose value, and theta quantifies this loss. Theta is expressed in dollars per day and is generally negative for long options positions. Let's see what the gamma is. The gamma represents the rate of change in an option's delta with respect to changes in the underlying stock's price. It measures how delta itself changes as the stock price moves. Higher gamma indicates that delta is more sensitive to price changes, making the option more responsive to stock price movements. Let's jump into the vega. The vega measures the sensitivity of an option's price to changes in implied volatility. Implied volatility is a market's expectation of a future stock price volatility. A higher vega indicates that the option's price is more responsive to changes in implied volatility. Vega is expressed in dollars per percentage point change in implied volatility. Let's go and explain the rho. The rho measures the sensitivity of an option's price to changes in interest rates. It is more relevant for long-dated options because changes in short-term interest rates have less impact on options with short expirations. Rho is expressed in dollars per percentage point change in interest rates. Understanding the importance of Greeks is really crucial for trading, as these are the technicals between why your contract price is going up and down. Understanding and using these Greeks is crucial for options traders to make informed decisions. Traders can assess the risk and opportunities associated with different options positions by analyzing the Greeks and adjusting their strategies accordingly. For example, if a trader wants to benefit from an increasing volatility, they may look for options with a higher vega, or if they want to minimize time decay, they may select options with a lower theta. Properly managing these factors can help optimize trading strategies and control risk in the options market. So guys, let's go ahead and go into some examples of how the Greeks apply to the options contracts. So right now we're still looking at the Amazon stock here. The share price is currently 137.82. So let's go ahead and look for a call example. So remember guys, the closer to the strike price that it's closest to the share price, it's going to be the most expensive contract. Therefore, it's also going to have different Greeks. So as you guys can see, the delta for the 138, since this number is so close to the 138 in this calls example, the delta is going to be higher, meaning that the more that this moves, the more money you guys are going to get, since it's technically already kind of in the money. Same thing, I'm going to go ahead and show you guys a little further out. So if you look at a number that's not too close to the current share price of 137.82 and you go to a further out call of 142, the delta is going to be a lot different, meaning that for right now, that even if the stock moves up, you're not going to get as much money as you would for the closest number, such as 138. Now this applies in the same thing as puts. So the current share price is 137.82. So and closest to that, the delta is going to be in a negative factor, but it's actually going to still apply to the same rules. So as you can see, this delta right here is -0.37 for the closest number here. If you go a little further out to 133, as you guys can see, the delta is going to be a smaller number. So guys, remember, you want your delta most of the time to be as big as possible, and your delta is going to let you know how your contract is going to move and how much money you're going to make. What are contract expiration dates? The stock options expiration date, often simply referred to as the expiration date or expiry date, is a critical component of any options contract. It is the date on which the options contract becomes void and ceases to exist. Understanding the expiration date is crucial for options traders and investors, as it determines when the rights and obligations associated with the contracts expire. Let's go ahead and jump in depth of the expiration dates. The expiration date is the specific date on which options contracts terminate. After this date, the contract no longer has any value or validity. Options contracts are time limited, meaning they grant the holder the right or obligation to buy or sell the underlying asset at a predetermined price before the expiration date. The expiration date is a key factor in options pricing and risk management. It sets a finite time horizon for an options position, influencing the options time value, known as extrinsic value. Traders must be aware of the expiration date when selecting options and crafting trading strategies. As options approach the expiration date, they may experience time decay, also known as theta decay. This means that the extrinsic value of the options decreases as time passes, especially for options that are out of the money. So, currently back here on Robinhood, and as you guys can see here, we currently do have the options table pulled up. So, to change the expiration date on Robinhood, now right next to the puts button here, you're going to see this little drop down. Now here guys, these are going to actually show you guys the buyable dates that are available for the contract. So guys, let's go ahead and show you some examples. So for instance, September 8th contracts are going to expire in 4 days. This means that on September 8th at 4 p.m. when market closes at Eastern Time, this contract will no longer be available to trade anymore, as it will expire in 4 days. This contract on September 15th expires in 11 days. The contracts for December 15th expire in 102 days. So make sure you guys do see what you do have selected, and the way that these contracts work guys is that once these days do pass, as soon as the certain amount of days that you bought are up, the contract will no longer be able to be tradable at 4 p.m. Eastern once market closes. All in all, stock options can serve various purposes, including hedging against stock price movements, generating income through option premiums, and providing employees with incentives tied to the company's performance. They are also commonly used by speculators and traders to profit from price fluctuations in the stock market. It's important to note that options trading can be complex and involves risk. An individual should have a good understanding of how options work before participating in options trading. I hope this video helped in explaining, and I hope it makes you guys' trading journey a little easier. Although, once mastered, the profit range is unlimited as your risk is only what you have put in, although the profit potential could be infinite. Thanks you guys for watching. If you guys want to learn how to become a profitable trader, click the link in the description below and book a one-on-one consultation where I'll teach you guys how to effectively trade, read the charts, and teach you guys the best strategies to become profitable. Make sure you guys like, turn on noties, comment, and share with your friends. Hope this helped. It's been Rethink Solutions. See you guys in the next one. If you're struggling with trading and you want to learn how to become profitable, click the link in the description below, guys. You guys can book a consultation with me. We'll go over all the strategies, and we'll also go over how to adapt your mindset to become a profitable trader. If you guys are interested, click the link in the description below, rstrading.as.me, and get with me. See you guys in the next one.